We have completed investment and gambling in the last lecture. We have completed the process. Next point is period. Investment are held for at least 1 year in investment. And in gambling, there is a very short period of time you are investing. So if we choose assets, if we select the assets, we can make a portfolio. So in the portfolio manager will select different investments for you, and it will be active, passive portfolio management. So this subject is security analysis portfolio management. Under this, portfolio manager will actively select the stocks which will give good returns, and it will create a good successful strategy so that you can get a profit from the portfolio investments. What is the basis? Investment is based on skills and required research. We're going to take ratio analysis, trend analysis. We'll do all these portfolio analysis in each and every stock you will analyze. You will select the stock after analyzing the portfolio, analyzing the different stocks. By using the standard deviation technique, covariance technique, correlation, covariance, these are the standard deviation. These are the tools through which we can decide the risk. We can minimize the risk of portfolio and maximize the return from the portfolio. And gambling is based on luck and emotions. Place. Investment is done in establishments such as banks and business. Gambling is commonly found in casinos. Odds are in your favor, odds are against you. Next part is portfolio management. Portfolio is a combination of physical assets and financial assets. Financial assets are investment alternatives, which we have studied in the previous lecture. These are equity shares, bonds, debentures, gold, silver, property, rare collections, etc. Portfolio manager will guide the investor to select the best securities after calculating risk and return. It will trade off. There will be a trade-off between the risk and return. It will minimize the risk and maximize the return. Portfolio manager is investing the funds in a combination, in such a combination that there are maximum returns and the risk is minimized. So we will make different portfolios, trial and error, and we will select the best portfolio strategy. Okay, so portfolio manager is creating portfolios with a proper process. There's first step is to identify the stocks which are performing well in the market. Okay. What is the definition of portfolio management? It is defined as the process of selecting a bunch of securities. This is the first step. Portfolio management can be defined as the process of selecting a bunch of securities that provides the maximum returns for a given level of risk, or alternatively ensures minimum risk for a given level of return. You have to minimize your risk. What is risk? Chance of losing money. You have to reduce the chance of losing money, and you have to increase the returns from the portfolio. So there is a step-by-step process which will which we will learn after this slide. What are the advantages? What is the objective of portfolio management? Advantages are security of funds, consistency of returns, capital growth, marketability, liquidity, portfolio diversification, favorable tax status. In detail, we will see in the next slide. What is security of funds? Investment safety is important for investor. All investors, they want safety of investment. If you want high safety, then you can go for income fund. And if you want low safety and risky stocks, then you can go for growth fund. Income fund is less risky, and growth fund is highly risky. So this is portfolio planning. When you are planning to select some securities, first you have to collect the data from your client, whether you want income fund or growth fund, and accordingly you can execute the portfolio. Second is whether you want continuous returns, like you want dividend every year. Some people, they want regular income from the investment. So for them, income fund is good because income fund is giving regular income, dividend income, interest income, but growth fund is not giving any dividend income. Next is capital growth. Portfolio manager guarantees that I will grow the portfolio. You have to hand over your money to the portfolio manager. He will collect money from you and he will tell you these are the strategies I have prepared for you. So with the stepwise, with the goal of client, he will ask the client how much returns you want, how much appreciation you want in the value of investment. And accordingly, he will study your goals and you will see that he will do the discussion on different assets which he is going to purchase. So with the tax planning, if you want to save the tax, accordingly he will make the portfolio. So he is very active person. Some portfolio managers are not active, but many of them are active because they want to see the capital growth in the portfolio. If they are not active, then why they are starting the service of portfolio management? Okay, and continuously they have to measure the performance of portfolio. After making the portfolio, they don't have to leave it and just you have invested and you will forget that I have invested in the market. So client will be taking follow up and he will take the review after investing into different assets. Client will definitely call again and again to portfolio manager, even monthly, 15 days may he will call his portfolio manager and he will ask what is the current status of my money, and portfolio manager has to pick up the call and he has to communicate with the client that I have invested and this is the current status, this is the current market value. If it is having a lower value after the investment, the value of stocks have gone down, then what portfolio manager will say that I will change the stocks which are not performing. So this is important. This is not like we have invested in safe instrument, now forget for 3 months or 1 year or 6 months, don't ask me anything. You cannot say client that you are aware about investments we have made, we have done proper investment, we are sensible enough. You can't say like that. If you are a portfolio manager, you have to support your client and you have to give timely information to your client. Then portfolio manager will ensure that he can sell those assets which are not performing. Marketability means immediately take a decision of selling those stock and being updated. He knows the updated market. He knows what are the IPOs coming up, which company is going to perform well, what is the fundamental analysis. Because of his expertise, and he will design the proper solution for the client. He will sell the stocks which are not performing after reviewing the portfolio, after reviewing the investments in stocks, debt, and fixed income products. So he's professional manager. He is not only going to advise, but he's going to take decision of decision as well as executing the investors investment according to his goals. Next is liquidity. He is having a good opportunity. Whenever he want to sell, he will take care that he take care at a short notice to give back money to investor. Sometimes investors have emergency, financial emergency, so they want to remove money from the market. So whenever you want to remove money from the market, you can ask a portfolio manager that I want this much amount back. So he will convert your securities into cash without affecting your portfolio. Next thing is you cannot invest all your money in gold or all your money in one company's shares. This will give you a big loss when the prices are coming down. So you will divide your money. Manager is diversifying your money in different assets. Some amount is investing in safe instruments, some are risky instruments, some are medium risky instruments. Next is tax status. If you have a big tax burden, if the client is saying I'm in the 30% tax bracket, please do something for me. I want to evade the tax or I want to reduce my tax. How to reduce the tax? By getting a tax deduction under various sections, mediclaim, LIC, and tax saving mutual funds. Okay, and if you are getting too much interest from FD, then also you have to pay the tax on the extra amount. Okay. So what is the tax exemption schemes like Sukanya Samriddhi Yojana? You are for female child, you are investing into Sukanya Samriddhi Yojana and National Pension Scheme. These are the some schemes which are giving tax benefit, tax exemption, I want to say. So we will suggest you to invest in PPF. We will suggest you go for National Pension Scheme. We will tell you to invest in Sukanya Samriddhi Yojana. Okay. And so in this way you can do your investments. Okay. A good portfolio manager will find out the favorable tax shelters to the investor. How to measure the risk? We will see the practical problems. First, what is the meaning of risk? Risk is loss, chance of getting a loss in the portfolio. That means you have invested 10 lakh rupees. If tomorrow or if after 3 months you find your money is only 9 lakhs और 8 लाख हो गया है, 2 लाख 3 महीने में निकल गया है, लॉस हो चुका है. So this is the loss which you are checking in the current status. The market values of different stocks have reduced because of which the portfolio value has reduced. So what are the different methods? for measuring the risk. The range is defined as difference between the highest value and lowest value. If highest value of share price of Glenmark Pharma on NSE is 1226 and the lowest value is 211 in past 5 years, then you can find out the range. Highest value minus lowest value. 1226 minus 211. So this is the range of 5 years. The price went down to 211 and the price was up 5 years back. The price was 1226. Now it is 211. So see the loss which you can make in the Glenmark Pharma. If you have invested at 1226, the value of stock is 211 today. You can see the range is 1015. This is the range, or that is the difference in the price. Similarly, the second example is of Sun Pharma. Share price highest value was 947 5 years back. Now the value is 338. Highest value minus lowest value, 947 minus 338. The difference in the price is 609. In 5 years, you can see the difference is 609. So what is the conclusion? If the range is too high, you can see the range of Glenmark Pharma is very high. So this security is more risky compared to Sun Pharma. Both are for industry. Both stocks are from same industry, right? Pharmaceutical. And but Glenmark Pharma is very risky because it is having a highest range. Highest range is too high, then the security or that particular share is risky. Now, what is the second tool through which we can identify the risk of the portfolio? Second tool is variance. Variance is better than the range because it takes into account the deviation from the average possible returns. The formula to calculate the variance is summation P probability into here. Before starting with the bracket, you have multiplication sign. Probability into returns, observed returns on daily basis, minus E of R. E of R. There's one more bracket in E of R. E bracket R. Expected return ER. Close bracket and square of this. Close again this bracket. You will get the variance. So variance is used for measuring the chance of loss, that is deviating from the average returns. How much deviation you will find in the stock. Standard deviation is square root of variance. After calculating variance with this formula, you can find out the standard deviation. Only you have to do the square root of variance. P is probability given in problem. Probability means chance of getting this return. Okay. R, these are the returns. These are estimated returns. That is why probability is given. Everything is estimated. E of R is P into R. When you multiply the probability with the estimated returns, you get expected return. From the following details, you are required to calculate the expected return of Tata Motors. In the economy, there can be boom, there can be a normal situation, it can be a recession. So in three situations, we will have the different probabilities. And the total of probability will always be equal to 100%, that is 1. If you make the total of probability, all three economic situations, 0.3 plus 0.5 plus 0.2, you will find 100% probability. Next is rate of return. With a chance of 30%, chances are there that we will get 30% return. 50% chances are there we will get 18% return, 20% chances of recession, and the returns are 10%. You can see in the boom situation, you are getting 30% return maximum. The normal situation, you are getting 18% return, and in recession, in the negative scenario, you're getting only 10% return. These are given in the question. You have to find out the expected return. You can see the formula above. E of R is P into R. Normally, probability is given, returns are given. These are estimated return. The situation can be of boom, situation tomorrow can be of normal, tomorrow situation can be recession. So multiply the probability with the rate of return, you will get the expected return 9, 30 into 0.30, 18 into 0.509, 10 into 0.202. Make a total of the last column, that is the summation. You can see the sign of summation here. E of R summation P into R. After multiplying, this is the product, and add all the results, you get the figure P into R summation 20. This is the result of expected return. Now this is the example of Tata Motors Limited and Ashok Leyland. You are required to calculate the expected return and suggest the investor. Wherever you are getting the higher expected return, you have to suggest your investor that we are going to get more in Ashok Leyland or Tata Motors. We'll find out, just see. Economic conditions are high growth, low growth, stagnation, recession. Probabilities are 0.3 with returns of Tata Motor 15%, Ashok Leyland 10%. 0.4% probability with return of 13% in Tata Motors and 11% in Ashok Leyland. Stagnation 0.2 probability with 9% in Tata Motors and 12% in Ashok Leyland. In recession, 0.1% probability, 6% Tata Motors returns, 14% Ashok Leyland. What is the answer? Just multiply first, we will do it for Tata Motors. We'll multiply 15 into 0.3, 4.5, 13 into 0.4, 5.2, 9 into 0.2, 1.8, 6 into 0.1, 0.6. Total of this is 12.1. We have calculated for Tata Motors, expected return is 12.1. Just keep it in mind. Again, we will on the next slide, we will calculate for Ashok Leyland. Probabilities are same. We will multiply with the returns. 0.3 into 10. 0.3 into 10, 3. 0.4 into 11, 4.4. 0.2 into 12, 2.4. 0.1 into 14, 1.4. When you make a total of expected return, summation of P into R is the resulting figure will be 11.2 for expected return. Now you tell me which expected return is higher. You can see 12.1 was Tata Motors, which is higher than the expected return of Ashok Leyland of 11.2. So what you will suggest to your investor? You are a portfolio manager. After calculating the expected return of both the stocks, you will suggest your investor that go for investing in Tata Motors. Skip the investment in Ashok Leyland.